Hello and welcome back. Joining me in the studio now to discuss the fixed income market is Annie Balmon-Raccah of KBR Advisors. Annie, thank you very much for coming in today.
Good morning, Natalie. Thank you for inviting me.
Okay, so to kick things off, what for you have been the key moves in the fixed income market in 2013?
Yes, we've been identifying three major moves. The first one being the steepening. Safe haven government bonds such as US Treasury and Bund have been posting negative to slightly negative performance since the beginning of the year, as rates at the medium to long part of their curve have been rising, while at the same time central banks have been committed to maintaining short-term rates at very low level. So the differential has been increasing quite dramatically. Also, the talks of the Federal Reserve since May about the possibility of the asset purchases reduction have been also weighing on the curves. The second move we've seen is on EM debt market. All maturity confounded, we've seen negative performance. According to JP Morgan Global Index, the performance is minus 8% year to date and has resulted in massive outflow. And the third move we've been identifying is the TIPS market has been crashing. TIPS being the Treasury inflation-linked bonds, and all maturity confounded, according to Bank of America Merrill Lynch, is also almost negative 9%, as this inflationary trend have been in place, and recently we've seen numbers of inflation very, very low level.
We've seen a lot regarding banks bolstering their fixed income business. Do this sector remain strong then, or is it simply that we don't hear as much about organizations shifting away from this market?
Yeah, if we think about the stock market has been unfortunately hit by two bear markets in 2001 and 2008. So over the last 12 years, we have been two bear markets in stock market, and as well we've seen also the aging population a need for having a recurrent income. So that has been favoring fixed income as an asset class. However, recently the trend is less positive, as we've seen banks and investment banks reducing their in fixed income businesses in the face of tougher regulation rules, and they have the obligation now to put more capital aside, and that is costly for them. However, we still believe that fixed income will remain a core business and profitable going forward.
How then are certain moves, such as, for example, FTSE's plans for a China fixed income push, how's that likely to change the market? And similarly, could we see equity loyalists, for example, taking that shift over to fixed income?
Very interesting question. Yeah, it's a very smart move from the FTSE, and of course it's an advantage for Chinese bond market, as they will become more transparent, more liquid, and also in terms of its global reach to investors. However, for us, we don't see really equity loyalists moving to fixed income. These two are two different animals as an asset class.
So how then would you encourage investors to weigh fixed income into their portfolios for 2014?
Yeah, as said during my latest interview with you, we believe that we are at the beginning of a secular uptrend in rates. So it's going to be a very tough and challenging year in 2014. What we are recommending our client to do is to really avoid safe haven government bonds and also high-grade bonds, as especially US and Europe, their incremental spreads of high-grade bonds are ridiculously low, 70 basis points, which is not enough to compensate for higher rates going forward. Also, we prefer European issuers over US, for instance, because US companies, both investment grades and high yield, are re-leveraging their balance sheet. So it's quite dangerous for bondholders, also less covenant for them. And European investment grade bonds still offer a lot of value, and also European high yield. We have to select them very cautiously. And also what we would like to recommend is buy some peripheral corporate bonds. And we think also there's a lot of value. However, we still believe that, as we said, 2014 is going to be a tough year in terms of interest rates. So we recommend our clients to hedge part of their fixed income exposure via derivatives, as we did for our fund and portfolio, which have posted 13% year-to-date performance.
Annie, thank you so much for coming in today.
Thank you for inviting me.
I'll be back shortly with more exclusive interviews for you, but for now, it's goodbye from me.